Okay, we are back. I'm very happy to have on the Goldstein on Gelt show the investment editor at the Financial Times, James Mackintosh. James, real pleasure to have you.
Hi, Doug.
There's a huge amount of political instability, and quite frankly, I'm feeling that it's greater than it used to be, I'd say even 5-10 years ago. Do you think this is a time for investors to kind of go back into their shells and begin to play ultra-conservative?
Well, it's a very difficult call at the moment. There's obviously been an awful lot of geopolitical upset, and it feels, if you look at some things, sort of Russian nuclear-armed bombers testing the limits of NATO, or the Chinese facing off with Vietnamese ships in the South China Sea. It does sort of feel like we've got a bit of a Cold War mentality coming back, but that isn't necessarily a bad thing for investors. I mean, some of the best returns investors made were during the Cold War. So it's not immediately obvious that exactly how geopolitics and share prices in particular interact. Obviously, any particular scare, Russian, activity in Ukraine, for example, can cause a shock, and it's possible that some of what's going on near you around the Middle Eastern region could result in some very messy outcomes, particularly if it hits the oil price. But for now, actually, the main geopolitical issues just don't seem to be having much effect on the markets, and I think that's primarily because they're mainly happening in places where not many people invest, where there isn't a whole lot of capital at risk.
So what would happen if someone, let's say someone is a retiree, or about to enter his retired years, and he has to make some decisions, and sometimes it's easier when people are younger to say, well, so you'll be a long-term investor, you'll have the ups and downs. But he says, if I go through another 2008, 2009 kind of crisis, I don't think I'll be able to pay for my retirement. How should he be looking at this political instability?
It's a really nasty time to be coming up to retirement.
Keep working.
You have a big advantage, of course. If you've been working the last 30 years, share prices actually are incredibly high. You've had a brilliant 30 years. So, in one sense, it's been great for you that your pension savings are worth more than they probably ought to be, that you've had returns that are probably unsustainable. The drawback is that for the future, for your next, hopefully 30 years of retirement, if you live nicely, you are probably going to have well below par returns, much lower returns. That's what the bond market is telling you, is that future returns are likely to be an awful lot lower, and particularly if you want safety, which of course, if you're retired and you're not going to have an income from anywhere else, you want that income to be safe. That's just very expensive at the moment, and that means it's going to be, frankly, tough.
James, there isn't really an answer to that. Any better. You got to say something that makes our listeners feel better.
I'd love to be able to. That. But I mean, it is. You should be feeling good if you're retiring now. You've just lived through one of the biggest bull markets in history. So if you haven't got decent pension savings at this point, that's bad luck. But you probably ought to, because what you should remember is even with the crash in 2008, 2009. The US market, for example, has come back so strongly since then that actually your returns over the last 10 years on equities have been exactly in line with the historical norm. This is the sort of thing that just happened. Markets crash. You should expect that from time to time. At least if you're retiring now, just remember how much worse it would have been if you'd been retiring in March 2009, just after the crash.
Right, and many people did. Let's look at the person who is in the United States now, or looking to invest in the United States, and depending which news channel he looks at, he's going to get a very, very different image of the state of the U.S. economy. On the one hand, people might judge it based on returns of the stock market. On the other hand, people might talk about unemployment or the fact that wages haven't moved. What's the best way for someone to really get a sense of how the economy is doing?
It's really tricky. Frankly, no one has any idea what the economy is doing. I think investors pay far too much attention to it. If you look at what economists think, or in fact, even look at the official statistics and how quickly they're revised and how far they're revised. I think the average GDP revision in the US, after it's published, over the following 2 years, it's on average been revised up by about 0.6 percentage points. Now, that may not sound very much, but that's a huge amount in the context of growth of sort of 2 to 3%. So really, the official statisticians don't really know what's going on in the economy until years later. There's no reason to think that shareholders should have a decent grasp on it either. And remember, what matters isn't really what happens in the economy. It's what happens to revenues and profits of the companies you choose to invest in. That's really what matters, and those are much easier to measure, or at least a fair bit easier to measure. And you should actually have a good handle on that. Now, of course, if the economy goes into a broad downturn or a long-run upturn, that's going to make a big difference to you. But it's very hard to judge when that might happen, how it is happening. I think, broadly speaking, investors and the market pay far too much attention to month-to-month changes and try to conclude that what will happen to the economy over the following 5 years because of what happened last month. And broadly speaking, that doesn't give you a good guide.
And of course, the media, of which you are a part, helps to get people excited about that. We're speaking with James Mackintosh, who's the investment editor at Financial Times, and he's got a very, very good ability, I think, and James, if I might say, having read a lot of your work, to explain to people what's going on in certain economies in certain parts around the world. Now, one of the areas that's definitely had a tough time picking up is the European Union, and given the difference of the different players in the EU, we're seeing it or at least I'm seeing it from my standpoint, it looks very difficult to find a way to benefit or even invest. And a lot of people are running scared from investing in Europe. Is now the time to run scared or to begin to move money in?
Well, there are areas that are starting to look really quite cheap in Europe, but nothing like as cheap as they were if you go back 2 years when really Europe was a screaming bargain, because everyone thought that Europe was going to break up, that the Eurozone, the currency, would break up. That obviously has turned out not to be the case. The European Central Bank is holding it all together. The problem is that it's basically being held together with sticky tape, and the fundamental problems haven't really been dealt with. They're probably not going to be dealt with in any sudden way. This is an issue that could go on for a very long time.
So do we have to worry that the likes of Greece and Portugal and Italy are going to once again drag down the EU and Germany is going to have to bail them out?
Well, I think that's entirely plausible. Greece's debt levels are completely, it's 170% debt to GDP. It's the sort of level that just can't be sustained, even with the artificially low interest rate it's got.
Why not take them out of the EU instead of taking the whole thing apart?
Take Greece out of the Eurozone, you mean, particularly?
Right, in other words, they came in apparently on false pretenses, so just tell them it's time to leave.
It did. Unfortunately, it's not quite as easy as that. When you break up a currency, it tends to have knock-on effects, because if Greece can leave, then Portugal can leave, and if Portugal can leave, then Spain can leave. And at that point, you're suddenly saying, well, actually, what's left? This doesn't really work, and you get a run on the markets if you start to break it up. So if you really wanted to try to break it up, the time to do it was a couple of years ago.
Let's just dig into this a little more. That's not quite clear to me. It seems to me that if you look at a big company and it begins to sell off its losing divisions, that would strengthen the core company, would bring money in. Wouldn't the same thing happen in Europe?
Well, if you think of it this way, say that you are Greek and you realized that Greece was going to leave the leave the Eurozone, and you were going to be given drachma instead of euros. At that point, you would immediately take all your euros out of Greece and put them somewhere else, or you'd take them in cash. You wouldn't, under any circumstances, want to have drachma, because you know they're going to collapse, basically. And the biggest creditors of Greece, of course, are official institutions in the Eurozone or other countries. So there are going to be very big losses to take. This isn't a free option for the rest of the Eurozone. Someone has to take big losses, and that someone's probably going to be Germany in particular, but the northern countries in general that have lent lots of money to the periphery. And if you start breaking up the Eurozone, all those losses get crystallized, and that's a very messy way to do things. And it particularly doesn't make any sense to do that now because you've already lived through the pain for 5 years now, really, of the problems of Greece.
But it couldn't just get worse? In other words, it's not a situation where we would want to cut off before it gets even worse and not just throwing good money after bad?
Well, it could get worse, but at the moment things have actually started to look up. So Greece has taken some hugely painful steps. Now, I'm not trying to say that Greece is a dynamic, thrusting economy nowadays, but it has done an awful lot of the work that it needs to do. Now, it still needs to do more, but it has shown that it can go through the sort of steps that really no one thought it could. It's possible, therefore, having gone through all that pain, that you ought to, at the very least, give it a chance to try and stay in.
Okay, so that's a little more optimistic, I guess, concerning Europe than we began the call, let's say.
Well, I don't think Europe's going to break up, but that doesn't mean it's a good investment. So if Europe turns into a Japanese-style model where you get a central bank that's unwilling to take the steps necessary to provide the liquidity necessary, and you get a sort of trade-off between countries that are demanding more liquidity from the central bank, easier money from the central bank, more QE type steps. France, Italy, Spain in particular would like to see a lot more of that. And on the other side, you've got places like Germany saying, no, really, we don't want that. We want a strong currency. We want to be paid back. We don't want to see inflation. That's quite hard to manage, and one plausible outcome of that, in fact, is stagnation and very, very low inflation. Now, that's great if you're a bondholder, and it's rather good if you're a lender, as Germany is, as a country as a whole. But it's, of course, terrible if you're a borrower and heavily indebted and would like to see your debts inflated away. That's Italy, Spain, Greece. Could really do with some inflation at this moment to help them along the way. It doesn't mean that necessarily they're going to be a complete disaster, but it does. If that's the outcome, then certainly bonds in the European periphery look like they've been overpriced. Yields are far too low. They're not. They haven't been giving you any sort of margin of safety for the risk that actually things don't turn out perfectly. And I think, broadly speaking, everyone just got a bit too optimistic this year, and things have been correcting. That doesn't mean necessarily that this isn't a choice between nirvana and disaster. You can have a sort of muddle through in the middle, and I suspect the muddle through is where we'll be. That won't be great for investors, but on the other hand, whilst peripheral bonds are very expensive, and I wouldn't want to buy those, the shares aren't looking particularly expensive. They're not a screaming bargain, but they're at least sort of reasonably priced, whereas American shares are looking very expensive.
All right, so we will have to keep muddling through Europe, and considering the high price of U.S. shares, as you've described. We've been talking with James Mackintosh from the Financial Times. James, in the last few seconds, just tell us, how can people follow you and follow your work?
Well, you can. I actually do a video every day, which is free on the FT, which is at ft.com/shortview. Otherwise, if you subscribe, I have a daily column in the FT, which I would strongly recommend everyone buys the newspaper for or subscribes to the website.
All right, James Mackintosh, thanks so much.
Thanks.
You've been listening to the Goldstein on Gelt Show with money maven Doug Goldstein. Doug's weekly radio show is heard around the world, but if you miss it, you can download the podcast at www.goldsteinongelt.com. The Goldstein on Gelt Show gives you up-to-date financial ideas so you can get on the path to financial freedom. If you'd like your questions answered on the air or off, send Doug an email to doug@profile-financial.com. It's your money for your future, so join Doug every week to build your wealth on the Goldstein on Gelt Show.